This is where we are, how are we moving forward? Like, what are goals? Is this realistic? Can automakers still maintain profitability? Can dealers still maintain profitability at this level of volume? We talk about Civic, the Corolla, those vehicles do well, but as a segment, things have definitely gone down. So it's like everything is funneling into the SUV. I mean, even the Altima looks like it's on the chopping block. So it feels like they're maybe in the middle of larger product renaissance of changing their product line. It is risky, and we're going to see a lot of this moving forward as automakers look to find a dance partner for certain things that they, perhaps are struggling with or unsure about, or don't want to go it alone, don't want to do the investment alone.
Welcome to the Car Dealership Guy Market Update, a monthly discussion with automotive industry experts and dealers about where our car market is today and where it may be headed. Today, I'm speaking with Jessica Caldwell, Head of Insights at Edmunds. But before we get into the show, the Car Dealership Guy Market Update is brought to you by Edmunds.
Welcome back to the fourth episode of the CDG Market Update presented by Edmunds. I'm here with Jessica Caldwell from Edmunds. Jessica, how are you?
I'm doing good, thanks. How are you?
Good to see you. So today it is just me and Jessica. We've got a lot to talk about. Last month was, it's pretty boring. Only a couple things happened in our industry, right? We had over 50% of the industry suffered an outage. No big deal. No, but in all seriousness, there's been a lot. So we'll dig into a lot of it and really go step by step into where we're at today and where we're going as usual. I think to kick things off, Jessica, we just finished the second quarter, as I just mentioned. Where does the industry stand? Give us a high-level overview.
Right. So I think if we look at where Q2 stands, it was pretty flat from where we were in Q2 in 2023, which is interesting because I think all the thought was you get more inventory, you get more incentives, things start to normalize, and one would think that sales would really start to go up. And we didn't necessarily see that massive of an impact. I mean, it was up about 8% from the first quarter, but that's seasonal. January and February volumes are terrible. So that's expected. But in terms of like seeing a raise and a lift from maybe last year's second quarter, I think that was more expected. So, to me, it seems like we're almost finding like our groove back after all of everything that's happened from, obviously inventory shortages, COVID, kind of finding like our new groove. So maybe this level of sales is, sort of where we are. I mean, we did have, of course, what you had mentioned, the CDK impact, but that was at the very end of the quarter. From a total volume perspective, wouldn't necessarily be as affected. But I think that kind of just begs the bigger question of, okay, this is where we are, how are we moving forward? Like, what are goals? Is this realistic? Can automakers still maintain profitability? Can dealers still maintain profitability at this level of volume? So I think that's, sort of the interesting thing at play here is like, have we found a new normal?
Well, tell me more about the CDK hack impact on sales.
Yeah, I mean, it's hard. Well, it is funny because everything that happens in the auto industry is such big news, but CDK was such a specific story that it was, it almost felt very inside baseball. But in terms of impact, I mean, it was quite significant, especially for, CDK customers. It did feel very mixed in terms of who was affected and who was not affected, and the levels of effect. Some people like, wow, this has been very detrimental. I'm sure you have a lot of good anecdotes on this. Whereas, others were not. But from like a sales standpoint, we did see softness in June. June SAR was about 15.3 around that. So a little bit on the lower side of where we have been tracking. So I think that was an effect. But if you look at the quarter from a volume standpoint, probably less, just because it happened at the very end of the quarter, but an impactful portion of the quarter where it was at the end of June, started to hit month end and also quarter end when you want to make these numbers up.
Yeah, I always like to define SAR for any of our new listeners that are joining in. Right, we're really talking seasonally adjusted annual rate, which really is referring to how many cars are we tracking to sell annually for the year. So it's pretty, I would say. Initially, I was more concerned when the CDK outages started happening, right? It was, I right away, I have reflections of my days, right, in a dealership when the DMS doesn't work for some reason, the, management system, it's just like a disaster, right? Everything's disrupted. I think that the industry very quickly adjusted back to manual processes as expected. But I would say that it's clear that with the numbers you just mentioned, that the industry was able to really, readjust and capture sales, which is obviously a positive for the car industry. Service is a different beast. I think the issue that lots of dealers had mentioned with service is that it's just not as easy to adjust to a manual process, right? You can't maybe hold a deal, paper it later, bring the customer back. It gets a lot murkier. You have you have warranty submissions, right? With the ROs pricing out different jobs. It got very murky. The other issue with service that many people may not have thought of is that service is always constrained, right? Everyone is always short on techs. Everyone is always at max capacity. So when you're losing that business, it's almost impossible to make it up unless you have people do overtime. And again, that has other consequences later down the line. Tough to say, tough to quantify service. Of course, we'll see with the public groups. But on the sales perspective, I think your numbers add up to, or they make sense, and anecdotally it aligns with kind of the sentiment on the street, which is that people adjusted processes and we're able to capture most sales. So it's pretty remarkable when you think that everyone lost, or over 50% of our industry lost, their pulse, right, their core software for at least 2 weeks.
Mm-hmm. I know. It's almost like going to work without a computer. Like people used to do that at one point in time. And it's like, how did you do anything without a computer? So I imagine, very similar, that you get used to a certain way of doing things. And, pre this, it's even hard to imagine. It's interesting you brought up service. I did hear from someone today that said, I just try to get my car serviced. I got to the point where you can service the time. And that's when the system crashed. And he's like, wait a second, I thought this was already fixed. And it's like, well, there's going to be lingering effects. It's not necessarily everything's fine and dandy.
No, it's been very glitchy. These systems have so many tentacles and they integrate with so many different things, and all these vendors. And so I'm still getting messages daily from dealers across the country just mentioning, hey, like this is still down, that, this software that connects is not working. People are still trying to smooth this out. But it seems as though, the big disruption is behind us. So that's a positive. Before we dive into brand specific metrics and how the brands have performed and continue to perform and who's doing better or worse, talk to us a little bit about inventory levels, right? Where are we at on inventory levels? We're coming off, as we all know, the last couple of years, historically low numbers on the new side. Where are we at today?
Yeah, inventory is looking a lot better. Just a little shy of probably around 3 million units, less than 3 million total. But to put it in perspective, before COVID, we pretty much ran like 3 to 4 million in terms of inventory in any given month. So being in like the high 2 million, almost 3 million range is almost getting us there, because as we knew before, that was too much inventory. Incentives were just everywhere. And even looking at like the raw numbers, it is a lot less than it was. So it feels like we're kind of in a healthy place. Of course, that's not for every automaker. I'm sure Toyota wishes they probably had more RAV4 hybrids, and any hybrids for that matter. But, and then on the other hand, you probably have, companies like Jeep and Stellantis with too many vehicles. So it's not necessarily a perfect science, but when we do look at inventory levels, I'm not really sure there's a need for them to get, a lot higher given where sales are, given the macroeconomic environments of high interest rates. It doesn't feel like they necessarily need to grow. So that's why I feel like we're settling into kind of this era of, perhaps more of a new normal where inventory shouldn't grow to like 3.5, 4 million, because we know that was not a healthy place and put a lot of pressure on the whole system. So, it's definitely looking.
What do you mean by that, Jessica? Like when you say that was in a healthy place, right? If I'm a dealer listening to this, I'm probably nodding. If I'm a consumer, I'm probably saying, hey, like I want more inventory.
I want the unhealthy place. Yeah.
Yeah, I want the unhealthy place. So like, what do you, and I want to also like parlay this to incentives, which I have some data there, which we'll talk about in a second. But when you say not a healthy place, do you think it's feasible for inventory to stay at this level? We are operating in a free market, right? And all these brands are competing. Like how realistic do you think that is?
I think it's fairly realistic as long as, we're listening to, or we'll have some Q2 earnings calls come up from all these automakers to see what their margins and profitability looks like. Because if that's good, then there really isn't necessarily a big need to turn things back up. Of course, everyone wants more market share, but it is really doing that cost benefit analysis of like, what does that exactly seriously does cost you to gain that share. And are there people there, even if you decided to turn the incentives on, are people going to buy the vehicles that you want? Because, nobody really wants to go back to, an era where days to turn for certain vehicles over 100. I mean, that does happen, but, not necessarily as widespread as it once was, because nobody wants sales to be that slow and have to just give these cars away. I mean, I just still think about the time post-recession where you saw deals like buy one Dodge Ram and get like a Dodge Neon for free. I mean, it was under the Dodge brand back then. But those type of crazy incentives that you don't even fathom nowadays, but they did exist. And that's what happens when inventory just gets out of control and you're forced to produce all these vehicles that you don't necessarily, that you can't necessarily sell.
Speaking of inventory, two things I want to add there. Right. Number one, I read a stat the other day that incentives as a percentage of vehicle price. I'm trying to. I think this was from Cox Automotive, but incentives as a percentage of vehicle price have sort of leveled off, which I found very interesting because in this increasing inventory environment, there seems to be that incentives have slowed. At least the growth has slowed. And I wonder, right, like, is that sustainable, right? We can't have it all. We can't have slowing incentives, increasing inventory, and maintaining margins. So that's the first question that goes through my head, right? Like, what happens next? Will incentives continue rising from here, right? Price has remained pretty flat. If you look at overall, average vehicle price, it's still around like 48,000. That's been pretty consistent. So something has to give. The question is, are we going to see inventory level off like you're saying, or will incentives take another run and continue increasing from here?
Well, I think we're seeing them level off and probably not be such a big percentage of sales, just because you see a mismatch in demand. I mean, I think there are some vehicles where there probably is growing. Some vehicles that are selling, like I mentioned, RAV4, hybrid is probably selling at MSRP. So I think when you take everything into consideration, it probably is flattening. But I feel like you have a lot of desirable vehicles, then you have some undesirable vehicles where incentives naturally are just going to be higher. And I think that probably is the case of what we're seeing right now.
I spoke with, and before we transition to that brand specific performance, which I want to talk about how brands are actually performing numbers. I spoke with a large Toyota dealer, and this was early last month. They wrote, still a big shortage of 3 to 4 year old cars. And I think these will get even more scarce in the months ahead as lease returns are going from low to non-existent, right? Mind you, this is massive Toyota operation. Relying on older or even new used 2024 models we don't have on a new car lot that we're buying around country, inventory to drive our used car offering. So, we've been talking about this lack of supply. It's, this is like, from the horse's mouth, right? This is real. There's fewer cars being returned from leases, as we've spoken about in previous episodes, and more of a reliance on these 3 to 4 cars to compensate for that. And so it's going to be also interesting to see how that impacts prices. And, again, there's always the, the long tail effect, right? Ultimately, more demand for those 3 to 4 year cars, more margin compression on the used car side, and the cycle continues.
Yeah, I mean, just for someone like Toyota, I mean, the question is like, will consumers just wait because they are brand loyal? And, if you want some of these vehicles, I don't know if there's necessarily perfect substitutes for them. So you may have, a line over at the Toyota dealership and a dearth of customers over at the Nissan dealership. And that, I think, is the imbalance that we are seeing. But yeah, that is the reality. I mean, we are seeing probably lease returns we knew were going to be an issue. I think we talked about this a few years ago because we could see how few vehicles were being leased and what those volumes are. And it's natural. It's like to have a used vehicle, you have to have a new vehicle first. And we know exactly how many vehicles were, potentially going to be, returned at this point. I knew that it was just a declining number, which is going to put a brand like, Toyota, which, once did a very healthy lease business, in a bit of a tough spot right now. So yeah, I'm not surprised that this is probably a lot of alarm bells going off.
The Car Dealership Guy Market Update is brought to you by Edmunds. In today's automotive landscape, car buyers invest more time than ever in researching, considering, and comparing options. But for dealers, the challenge lies in pinpointing the audience ready to make a purchase. Enter Premier by Edmunds. Premier offers dealers a groundbreaking way to connect with in-market car shoppers precisely when, where, and how they prefer. With over 20 million monthly visits, Edmunds.com is the go-to destination for buyers seeking market insights, expert advice, and budget tools to make informed decisions. These shoppers aren't just informed, they're laser focused on the exact car they want. Now, it's your chance to make that connection. Through Edmunds Premier, dealers gain access to this highly coveted audience. Simply list your new and used inventory on Edmunds and watch as qualified in-market traffic flows directly to your vehicle detail pages on your website. Don't miss out on this opportunity to elevate your dealership's visibility and sales performance. You can sign up for Premier today at edmunds.com/CDG. And here's a special offer only for CDG listeners. New customers signing up through edmunds.com/CDG will receive an exclusive 50% off pricing for the first 90 days. Again, visit edmunds.com/CDG or click the link in the show notes below.
Yeah, look, I think more margin compression on the used car side doesn't surprise me. I have frequent conversations about that with used car dealers or new car dealers with big used departments. I think the other thing that I think through is I feel like the wholesaling market will continue getting more efficient. And what I mean by that is dealers are buying cars at record volumes, off the street, quote unquote, from consumers. But I think that, the pressure is on for wholesalers, maybe auctions or, B2B marketplaces to get more efficient and continue strengthening their value proposition, right? Because it's not just, of course, supply is a big driver of it, but, price obviously matters, especially in an environment with declining margins. So I just see that. I'm speaking sort of out loud here as I see what's trending in our industry, but that's an area that I'm really kind of, focusing on and trying to see how that's going to continue evolving.
Yeah, I mean, it makes sense. Are you hearing just a lot of trepidation amongst dealers about like what to buy and how much to buy it for, just because we've seen such an up and down in terms of some of the used market over the past few years? Because I felt like that was very much a sentiment at one point.
Well, I think, first of all, when it comes to the used EVs, lots of used car dealers are still taking advantage of the tax credit there. So that is absolutely having an impact. Used EV prices have come down a lot. They've sort of stabilized. And again, it's not surprising given that demand is increasing, with consumers. That's something new that was started this year with the EV tax credit. I would say, to answer your question directly, I don't know if trepidation. There's definitely, people are dealing with just margin compression, and they're facing it head on. And remember, they're doing that in an environment where interest rates are still relatively high, right? We haven't seen these levels in about 2 decades. So all that said, the environment is challenging. We'll talk just in a second about performance on the new side. But even on the used side, I do this tweet where I say, hey, dealers, tell me how you're doing in the market. And, lots of dealers comment on it on X, and they say, hey, kind of this is my sales. And, we'll then many times, have phone calls or messages, and we'll just talk about, kind of their specific market performance. And it's just been very spotty. Like different regions of the country are, operating or they're really different volumes, and some are doing better than others. But overall, it seems like, the conversation I have a bit more often is about margin.
Is there rhyme or reason to some of the regionality? Because I think that's pretty interesting too. And it kind of goes along with even some of the brands being seemed spotty demand in different places. I don't know if you've heard that.
I don't think I have any like good consistent trend that I've noticed, but I'm curious to know, what do you think in terms of performance of the brands, right? And specifically standouts, right? Like any brands performing great, not great, where are we at?
Yeah, I mean, it is kind of the usual suspects. I think of what you would expect when their sales reports came out. I think it was just, right after the month had started. You still have brands like Nissan, Stellantis, definitely struggling. They're showing, quarter over quarter or year over year rather, declines versus Honda, Toyota, done very strong, I would say. So it is a bit of a mixed bag. The majority of brands, I think they saw a pretty decent lift over last quarter. And I think that was to be expected. And year over year, I'd say a lot of them were in the same place. But a lot of the trends that we have seen have continued. We have seen some of the Japanese brands do quite well, and with the exception of Nissan, which some news just came out about some of their product lineup shakeups, which I think is quite interesting, of what they're rumored to discontinue, get rid of a lot of their sedans. I mean, even the Altima looks like it's on the chopping block. So it feels like they're maybe in the middle of a larger product renaissance of changing their product line. But it is affecting them right now here on the ground.
Why do you think that is? Like that's a statement that I would have been, first of all, I'm semi-shocked to hear it now, but even a couple years back to hear even the Altima might be on the chopping block, or like, why do you think that is?
The news out there right now is that they will discontinue the Versa in 2025, and then the Altima likely in 2026 or after that. So that would ultimately leave them with a Sentra as kind of their only car. And they've already cut Maxima. So for a brand with such a strong, I would say, car presence for many years, it feels like Sentra was like one of a lot of people's like first car experience, and then Altima, the midsize sedan. I mean, that was a pretty hot car there for quite a while. I mean, it's been probably over a decade, but when that was redesigned, maybe like in the early 2000s, that definitely got people to turn their heads and got them to consider the Nissan brand, which is so important. But it does feel like it's kind of following the industry of shuttering a lot of these car lines. And, I think, Nissan's been, kind of bullish in some of their statements as it relates to EVs. So it feels like they're changing some of their products now, internal combustion engine products, and, leaning heavily more towards the change for their electric vehicles. They've talked about, some SUVs joining on the EV side, and then following that, some sedans. So it feels like maybe these nameplates will come back, but perhaps not as internal combustion engine vehicles, maybe as EVs.
Yeah. I mean, look, I think it's clear that it seems like every year we're just losing more sedans, and it's not a shocker if you just go outside, like look at the street, right? You see more and more SUVs, but it's definitely clear that, I mean, it's if you hitting the Altima or potentially, and like the Sentra, these type of vehicles, these are like the bread and butter vehicles, and so it's clear that their industry has completely fundamentally shifted, and automakers are taking that into consideration for all their future models. I want to go back to a point you made. We were talking about the brands and performance in the market. I want to close the loop on another conversation we had on a prior episode, which was we spoke about brand loyalty. And you shared some stats with me, right? You put out a bunch of stats about market share. And I think I found it fascinating to see that Toyota's market share was up 12% year over year in Q2 from 2023. And I'll tell you why I find that fascinating. Because we all know Toyota has brand loyalty. And I will also mention brand loyalty has eroded a ton over the last couple of years. But that's a massive percentage. Like, that's by far the largest percentage gain out of any brand in Q2 year over year, by far. I think behind them is Volkswagen and Audi that gained 7.2% gain in market share. So almost double. And it's pretty fascinating because we knew that Toyota's lack of inventory was pushing buyers to explore new brands. But if this tells us anything, it's that the Toyota buyer is very loyal, like you said. And maybe this is not the buyer that purchased a competing Subaru or Hyundai or Kia the last couple of years. But needless to say, it shows that as they continue rebounding inventory, the brand is just very, very resilient and is able to bring that customer back and grow at a pace like this. And you even mentioned that they're still lacking hybrids. And so it's tough to not be just bullish on the brand and imagine that if they were fully stocked with hybrids right now, that their market share would be rising even faster.
Right. I mean, I don't know if you saw on their sales records for June, Prius sold 13 units. And we know demand for that vehicle is way higher, obviously, than that. It's probably one of the hottest vehicles in the country. So the fact that they couldn't sell those, because when I saw some of the June top line numbers for Toyota, I thought, wait a second, this doesn't seem in trend. And then when you actually look at how some of their vehicle results, it's like, well, if you can only sell a few units of...
How do you reconcile that? Yeah, how do you reconcile such great performance and in Prius 13 units?
Yeah, I mean, they're going to either have a monster July and August as soon as they can start selling these vehicles again. Because I do think Prius is one of those vehicles that people will wait for. If you want a hybrid that is, I can't believe I'm saying this to describe Prius, but kind of cool design. There's not a lot of options out there, especially that are more affordable. So yeah, and then on the flip side, you look at RAV4 sales, they were over 40,000. I mean, the RAV4 almost looks like, one of the Detroit brand pickup trucks.
That's a good analogy. All right, so let's go to the not so good, right? I had Aaron Ziegler on the podcast recently. If you're listening to this and you haven't listened to that episode, you have to go listen to that episode because it was very, very good. But we discussed Stellantis, also known as Chrysler, Dodge, Jeep, Ram, Fiat, and others. And again, another sort of eye-popping stat here that you shared, which is down from 10.6% vehicle market share in the US down to 8.4% year over year. That's a 20.9% decline year over year. Anything new that we should know about Stellantis, right? We've been pretty vocal about their struggles with pricing, with, vehicle selection. Anything new going on there?
I mean, I wouldn't say new, but I mean, the one thing that is concerning more on the business end is that they've had quite a few top executives leave. And it seems like, when I look at the news for them, there's another executive that's gone. It's like I'm seeing more about that than the actual product, which is concerning. So I don't know what's happening over there, but obviously when you see this number of high-level executives leave a company, I don't know if they're in a transition or what's happening, but that's not probably great news, especially in the short term, just having that sort of revolving door of top management.
Yeah, no, I highlighted, that's a great point. I highlighted a couple of those departures, at least 3 big departures. And the most recent one was someone in their software tech department. I forget the exact role. Now, the reason that's very meaningful is because, engineers typically, at least from my experience, are like pretty loyal to their leader. Not to say that other, different departments aren't. But like manufacturing and stuff like that, it's a bit different, I would suspect. Software engineers, it's a different, or there's that certain loyalty to your leader and kind of buying into the product vision. To see that many leaders, especially like a software leader or a tech leader leave, it's pretty concerning. I feel for the Stellantis dealers, it's not a great position to be in. But if you look at on the optimistic side, deals have gotten a lot better for consumers, right? So that's a good thing for consumers. And on the dealer side, you could make the case that, maybe the company hasn't hit like the bottom yet, but it could be a buying opportunity soon, right? Ford went through a similar thing over the last 2 years, where it was, dealers on my podcast were saying, I will not touch a Ford dealership. I will not buy one. I will not acquire one at any cost. Valuations fell. And then since then, it seems like the brand has rebounded. And so, these things go in cycles. I think there's a potential opportunity there for Stellantis and for dealers to take a look, especially because you are seeing some more Stellantis dealerships pop on the market, or at least, owners being open to selling. Again, that's my anecdotal observation, again, from conversations. But nonetheless, I think that, if you're ever looking for a time to get into that business, we may be approaching a bottom and no one can time the market. It just, I think of it like opportunistically, right? If someone is not doing well, right, is that an opportunity?
Right. And that company's had 9 lives. I can't even name all the owners that they've had since bankruptcy. So, are they, because I feel like they've always been like, oh, are they really going to survive? And they've managed to do it every time. So yeah, I do think that even though things look not great at this point in time, the likelihood of bouncing back is probably pretty high for them.
They're a good example on what we just discussed about, right? The shift to SUVs, right? Jeep, Chrysler, Dodge. I mean, it's really, these are SUV brands. So talk to me a little bit about just how we've been trending from market share by segment, right? You just mentioned the Nissan stuff. Stellantis over here is not doing too hot, but they're very SUV heavy. So where are we at with market share by segment? How is that evolving?
Yeah, it's almost a product story, really, because if you have all these car brands shutter, where are people being naturally funneled into? A lot of times they're funneled into, smaller SUVs. So yeah, you look at way things like subcompact cars have trended over the years, like pre-COVID versus now, there's hardly any on the market. So it's like, I want to say it's like less than 1% versus it was, much more lively quite a number of years ago. And, the same thing with compact cars. I mean, a lot of people talk about they're doing well, and they are doing well in the short term because the ones that are left do quite well. If you talk about Civic, the Corolla, those vehicles do well. But as a segment, things have definitely gone down. So it's like everything is funneling into the SUV segment. I'd say more strongly probably on the smaller side. We'll continue to see compact, smaller SUVs grow. They have grown. They're a big portion of the market. There may be some affordability issues, not for the larger SUVs, even maybe starting at midsize, because those have gotten very expensive. You think about just some of the normal nameplates that a lot of consumers deem affordable, feel like they're not very affordable nowadays. So probably some issues there. And then I think trucks are interesting as well, because when interest rates went to 0% for 84 months, like everyone bought their big truck because it was like the moment they had been waiting for. I mean, sure, we were in COVID, but whatever, that logic was pushed to the side. And we just saw the truck market share really spike. And now things have reversed. We're seeing it definitely go down from where it was. I mean, I'd still say it's probably in a higher place than we saw pre-COVID. But from where we just saw it recently, it definitely has started to taper off a bit. So a lot of movement, I'd say, with the segments, but it does feel like all the products that consumers are buying is being kind of in an SUV type of vehicle. So that naturally is going to be increasing over time.
All right. Speaking of consumers, right? This all impacts the consumer at the end of the day and how dealers conduct their business. Comscore put out a stat that pre-qualifications by bank lenders more than doubled year over year. They went from 25% to 53% of consumers. I think everyone here listening that has either shopped for a car or is selling a car or is a dealer or is a GM or sales manager, whatever, right? We all know that, affordability has been top of mind for everyone. And that's frankly the biggest challenge at the dealership. It's all lumped together, affordability, negative equity. It's all kind of one big thing. And we'll talk about each one. Pretty big jump in pre-qualifications, which again is emblematic of the broader trend in the industry. Can you give us an overview of the health of the consumer today? Where are we at from payment perspective, interest rates? Just give us like a high level overview of how things are shaking out.
I mean, the consumer is stretched right now. And I imagine people listening to this podcast have probably see this person kind of come in every day to the dealership is that, financially, it's very tough because it's not only have, cars gone up in price, everything around us has gone up in price. So trying to make those trade-offs of, okay, I need to buy a new car. Now, what am I not going to spend money on at this point in time to be able to purchase that? I mean, we have high interest rates. The new APRs averages still over 7%. We've seen that for a number of months. It has not dipped. It feels like kind of the Fed has been like.
Is that for new or used when you say the average APR is over 7%?
Yeah. So if you look at new vehicles, what are the average interest rates on the loans in the country? They're still over 7%. Definitely, still quite high. And when you add that on to a $50,000, $60,000 vehicle, you get these record high monthly payments over $700, which, as an average feels, extremely high. I feel like I have these conversations with people in different parts of the country, maybe cost of living is a little bit less. And they're like, that's how much I pay for my rent or my mortgage or whatever it is. It feels like those are the payments they're turning into. So we do know that the customer is very much financially stretched, but not just in the auto space, in every space. And I think that's what's really challenging right now.
Mm-hmm. Okay, so new is over 7. Where are used APRs at currently?
Mm-hmm. Yeah, used APRs are even higher. I mean, they're over 11%. So, if you're a used buyer out there, I mean, I think that things like certified pre-owned certainly help, especially if there's some sort of subsidized interest rate programs. But yeah, I mean, used APRs are extremely high. So, I mean, those shoppers that are doing the research to figure out like, what does my loan look like? Not only just shopping your vehicle, but shopping your loan as well are probably the ones that are going to be the happiest because there's so many moving pieces. And it's something that I think consumers didn't even really think about. I think they just kind of turned up to the dealership. They kind of knew what car they wanted to buy. And then they kind of settled all that in the F&I office. And now that's probably why you're seeing these pre-quals go up because the loan portion is becoming such a big part of this process. Can I even afford this because of the higher interest rates and the higher prices?
So Jessica, Edmunds also put out a stat, which I follow this very closely. You put out the stat about consumers buying vehicles at payments over $1,000 a month. this has just become sort of this like barometer for consumer spending, the car business, the health of the market. And in Q2 2024, 17.8% of all loans taken out on new vehicles, right? 17.8%. So nearly 1 in 5 consumers paid over $1,000 a month, right? Now, and by the way, that's shy. That is just 10 basis points shy of the record, which is 17.9%, which was in Q4 2023. So we're pretty much at the record or close to it. What I find interesting is new car prices haven't gone up, but incentives have. Incentives have actually spiked over the last year. And, this is only, call it 2 to 3 quarters out. But what gives, right? Like, are consumers just going after more expensive vehicles? Are people making more money? Is it inflation? Is it all three? I mean, what's happening?
It doesn't feel like people are making more money. I feel like everyone is saying that, like, I'm not making any more money, even though things are a lot more expensive. But I mean, I do feel that like people have these, vehicles that they, that they want to buy. And I don't know if they're justifying to themselves because everything is more expensive out there, but you can buy in some of these prices with the, the high interest rates. And the interesting thing about right now is that we are seeing incentives on interest rates. Like there are subsidized programs. They're not the best. They're certainly not how they were pre-COVID, but they are out there. So we should, in theory, start to see that average incentive or average interest rate go down, but we're not necessarily seeing that. So I think people are probably paying a higher interest rate on the higher end. So people maybe with worse off credit, and they're kind of going on that side of the equation, which is keeping the interest rate at where it is. So I think that probably is some of the dynamic that we're seeing out there, because it should go down. And that's what I'm looking for. I'm looking for that moment in which incentives will impact it enough for that number to go down, and we just haven't seen that yet.
And that's what I'm following as well. So it's going to be very interesting to see this next quarter, especially with incentives that have sort of plateaued, whether or not that'll keep rising and how that will impact us.
Yeah, I mean, I think the key thing here is just loan terms, because we definitely like to extend the loan terms for as low as possible, and a lot of the incentives that are offered are for relatively shorter loan periods that Americans don't want. I mean, if you're not offering something for over 60 months, I'd say it's not going to appeal to a lot of people. But I think those are the sort of the numbers: 60 months, 72 months, 84 months. That's I think what people really, that's when you start to get like the heads turning.
Mm-hmm. So before we wrap up, I want to touch on negative equity, because there's been some changes there. Can you set the table for us on, again, where are we at in terms of negative equities in industry? How are things trending? Well, we know how things are trending, not good, but if you could just be more specific on, specifically the numbers behind how things are trending.
Yeah, I mean, when used values and trade-ins were so high just a few years ago because we couldn't make cars, this was not an issue because everyone was so happy. It was like, I mean, I remember even seeing these stories that, we helped put together, like, are you sitting on a gold mine in your driveway because your vehicle that theirs could be worth so much money? And it was the case. People were delighted on how much money they were getting for their trade-ins, and things are starting to normalize. And, as a result, we're starting to see negative equity creep back up. I mean, it was very low, and it is still lower than it has been historically. There's been points in time where it has been higher. But I think probably the more concerning thing is just the amount of negative equity that's at a record. It's over $6,000. So people are rolling $6,000 into their next car loan. And that, that's probably how we get these very high monthly payments as well. People taking advantage of that. So I think that probably is fairly concerning, because we have these people that are trading in relatively not very old vehicles, and it's sort of like, why is that happening? And are they okay with that decision? And as a result, this the amount, like I said, is hit a record level. $6,000 is definitely a lot of money.
Mm-hmm. Do we know, adjusted for inflation, if that is still a record, or we're unsure on that?
It probably is. I mean, looking back in time, it usually was a lot lower. Like, it probably is a function too of car prices going up as well. So maybe adjusted for car price changes as well as inflation, maybe things are, more directly to car prices. But I'd say that it likely would be.
So drilling into negative equity, and this is the fun part, right? We see
One part
that
of negative equity.
EVs, well, yeah, well, as you know, as fun as it can be for the conversation, it's obviously not a great situation either way. But we do know that EVs are at record levels of negative equity and are driving lots of this. And again, every dealer listening to this knows this, right? If you held on to EVs as prices were being cut, you felt it. If you didn't, you saw the price drops. But EVs are leading it. Now, again, I like to think positively. And I ask myself, right, whenever there's, quote unquote, a crisis, well, what's the opportunity? And I think the opportunity here is, check out this stat. This was actually, we wrote it in our Car Dealership Guide newsletter. I'm not sure what's the primary source. It isn't sourced in a newsletter, but the team pretty much put together this stat they shared. And they wrote that the average mainstream EV is now just $1,500 more than its gas-powered counterpart. And here's the crazy part, right? That's down from $8,400 of difference in May 2023. So what that tells me is that, we are likely past the big drops, right? Or let's say it differently. Prices of used EVs and used gas are likely closer to parity at this point, or getting closer. And for all the dealers that I've spoken with who were kind of, scared to touch EVs and have the demand, right? I'm not talking about the areas of the country that maybe don't have the demand for electric vehicles, and that's totally normal. And we're strictly speaking here about just from like a money-making capitalist perspective, right? I don't care about like pro, anti, I could care less, right? It's an asset, it's a piece of metal, can it make money? But in all seriousness, right, when you think about that, it seems like the two different types of vehicles are getting close to price parity, which as a dealer, I would perceive it less risky to potentially try to retail some of those vehicles if I have the market for it. So an interesting data point. Every dealer can listen and can do it with it, as they please. I know people are very passionate about this topic. To be honest, I'm not. I'm very dispassionate about it. It's just, it's nuts and bolts. But that's just my opinion. But I'm curious to know if you have any thoughts on that.
Yeah, no, I mean, I think that's an interesting stat just because, if that is the case, then what is the issue? Like, why are people not necessarily that interested? And I think it kind of points to, something that we have been talking about, just the other challenges of owning an EV, because it's not a one-to-one substitute, an EV and internal combustion engine. You have to do you need a whole new system. And do people just not want to do that? And is that what's ultimately going to hold things up until the infrastructure is as seamless as, having a gas station? Because that is something that always comes up in surveys, is that consumers don't want to deal with the hassle of owning an EV. They're like, yeah, sure, it's, it seems fine, but, I don't really want to go and do and learn all these things, because technology scares people at the end of the day. New technology is scary. Doing different things differently is scary. Kind of departing from what you have known your entire life is also scary. So getting over these psychological hurdles seem to be the issue, because if price is not an issue anymore, then what is exactly going to hold it back? And maybe we have to start addressing some of those concerns. So it's probably a high education piece that will need to focus. So it's going beyond product and price, but more.
And speaking of scary, it's not just the consumer that may be scared. It's also the OEM. Recently, Volkswagen Group announced that they are going to invest $5 billion in a joint venture with Rivian. This sort of kind of sent shockwaves through the industry, because it was like, wow, surprising, a legacy auto manufacturer going to invest in Rivian, one of the EV, upstarts. What's your take? I mean, what is going on? Are we going to see more of this type of, it's some form of consolidation, right? At least capital consolidation for this, for developing this technology. But what's your take on this investment by Volkswagen?
Yeah, I mean, from the Rivian standpoint, they need money. I don't think that's probably too much of a question. They need the cash. I think from the Volkswagen standpoint, probably getting a better hold on, EVs in general, probably specifically as it relates to software. They have been developing EVs, fairly aggressively, and they haven't necessarily, I'd say, set the world on fire with them yet. So developing better vehicles. And, to me, it's just like, you got to pull back for Volkswagen, because it feels like they haven't really been the same since maybe like Dieselgate. It felt like the company changed rapidly from that point, and there was a lot of pressure on them post that point to make environmentally friendly vehicles. So perhaps maybe jumping into the EV space, like almost kind of forced into it. Like maybe it wasn't necessarily the biggest passion project there, but it was something that they had to do to, perhaps change their image a bit. It's kind of got to them to this point where maybe their EVs don't feel, as good. They make quite a few. I mean, I'd say the quality is different amongst all of their brand portfolio, but I'd say there's probably not like necessarily like a class leading, like we would talk about it, in great lengths of how great it is, right? So, I think developing that better vehicle is sort of what they're aiming to do in the future, against a lot of their rivals who, probably have a lot more buzz in this area.
So what do you think, if you had to sum it up in like one word or two words, right? Good idea or good investment, bad investment? What's your take?
From a strategic perspective, I think it was a decent decision. It's just that Rivian is a startup, so how much do they really have there? I guess that probably is the question. It's but maybe that's what a legacy automaker needs. Is that component of it, because they can already they got the manufacturing portion down, but it is the other things that they need help with. But it is risky, and we're going to see a lot of this moving forward as automakers look to find a dance partner for certain things that they perhaps are struggling with or unsure about, or don't want to go it alone, don't want to do the investment alone. I mean, I think this has been common. It probably is just going to be even more common, especially, because we have electrification, which, obviously we talk a lot about, but also autonomous technology that's coming fast and furious as well. So it's like, these are big changes that are going to completely change the auto industry. And that is a scary, expensive proposition.
So talk to us about the next couple of months. I mean, what's your outlook on the next 3 months? I feel like I gained a lot of gray hairs over the past 30 days. So it shaved a couple of days off my life over all the craziness that we just experienced in the last month, with the hurricane and CDK. Obviously unfortunate, but just been very, very hectic. So what's in store for the next 3 months? Talk to me. What do you think?
Yeah. Well, I mean, here's the deal. I think what we are seeing now is just like a series of black swan events. Like, it just feels like before a hurricane or something like the CDK would send us like, we would go into panic. And now it just feels like, oh, it's just another crazy thing that's happened in the auto industry, because it feels like there's so many of those. I'd say for the next 3 months, things should be fairly stable, but we do have an election on the horizon, which can completely change things, especially, on EVs. But, with the election cycle, I think coming up, that can really start to change things. I mean, especially if we have a new administration, that can really affect some of the, the rebates that we're seeing for electric vehicles. And if that's the case, what would it do to that market? I mean, I think right now, EVs are pretty much selling on leases. I mean, we have, almost 70% of EVs are sold on leases, and it makes sense with the tax credit. If that was to go away, what is happening to this market, especially since this whole conversation has been about all these companies investing so much into this technology? Like, where does that leave it? And then all of a sudden, will it change again in 4 years' time from now? And that uncertainty, I think, is probably pretty hard for automakers to grapple with. So that is, I'd say, probably a big that could be a big potential change in 2024. But I think, from the ground level, I'd say for the next few months, I feel like things are going to kind of carry on as what we are seeing. It's just the bigger picture, I think, that's a bit more discerning, and it's not really even a long-term look. It is pretty much in the short term.
Any winners or losers that you're forecasting for the rest of the year from a brand perspective? Anyone you think, do you think we're going to maintain course? Do you think we should expect to maybe break some trends? We know the usual Stellantis, Toyota outperforming, Stellantis underperforming. Anything else on the horizon that you're paying attention to?
Yeah, I mean, I don't think there's anything that looks like it's going to go off course necessarily. It feels like things are going to kind of stay as they are. I mean, there's not really any catalysts and things that are moving. There's not necessarily any massive product shifts. I mean, hopefully, Toyota can get some Prius numbers up, because 13 is probably not going to be good for them for the rest of the year. I imagine that's probably different already, but from an automaker perspective, it's not as if there's any big changes. Incentives could change things. Someone gets a bit more aggressive with incentives. I mean, Stellantis did, admit that they do have a pricing issue. They have addressed it a bit. Are they going to do it more aggressively? So I'd say smaller changes, but not necessarily any structural differences, expected, at least in the short term.
Well put. Jessica Caldwell, always a pleasure. Thanks for coming on.
Thank you.
This episode is brought to you by my very own car dealership guy news. CDG News is here to help you stay updated on all things automotive. We're not your typical news crew. We're bringing you concise, unbiased car industry news in easy to digest formats. From the hottest headlines to podcast summaries, dealership best practices, and industry insights, we've got it all covered. And guess what? It's all free, no paywalls, just like we always promise. Hop over to cdg.news, that's cdg.news, and check us out. We're all ears for your feedback. Tell us what you need. Give us your honest thoughts. We're here to deliver real value. So don't wait. Head to cdg.news now or click the link in the show notes below.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.